And knowing and understanding these numbers for your property really helps you uh, treat it like a business. Like
Mm.
you said, once you have the knowledge of those actual statistics, you can take action on them. Whereas if you're not tracking them, you don't know what they are, then you're not sure what you can or should be doing to improve your property.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Are you ready to start investing in real estate today but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with homeinvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer a property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars to claim your free course today. Hello, welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, as always, is John Stiles with Bridge Realty. John, how are you doing today?
I'm doing great, Todd. It's a really good day to be alive. How about yourself?
I am doing fantastic, man. It's week 2 into the new year. We are rocking and rolling, so time's flying, and hopefully everybody's on course for their goals. And if you're not, kick yourself in the butt, get in gear, and get going on those goals.
Yep. I was just going to ask you, are you on pace? We're in week 2. Are you on pace?
You know, some goals are not quite measurable, right? At least right away. So just trying to do things that are going to get me to my goals. Most of my goals are not going to happen day one, such as I want to buy, 600 units this year. That's not going to happen day one. Maybe I could close on 600 units within the next few months, but that would be great. But then I would be starting a new goal because I wouldn't just want to stop there. But yeah, so just working hard at trying to continue to make sure I do things the right way and improve upon them. I've heard it said before. I can't remember who the first person I've heard say it, but I really like it. As they say, you need to improve upon each and every day. So it's taking what you did the day before and figuring out one little thing that you can do to improve upon your day before. If we can do that, we're going to have a lot of extremely good growth and going to be able to achieve those goals.
Yep, for sure. I'm counting this week as week 1 for me. You recall last week I was pretty sick. I'm getting over it now. I think this is the end of it, but I have some very specific goals with not really achieving things, but actually just they're action oriented, just things that I can really do and measure. And so far in these couple of days here, I'm on pace. So we're hopeful.
John, I think that's actually a good point when people who are looking at writing goals, maybe you haven't done your 2019 goals yet, or maybe you do shorter term goals, but actionable steps are maybe even better than just a long-term goal. So having the long-term goal is great. John, maybe you want to sell 1,000 multifamily units or whatever you want to do. But having actionable steps as your goal, that's really powerful because it's very easy to measure. So I think that's really good. Uh, Especially, people, for instance, for you, I don't know what exactly your goal is, but if it's to call a certain amount of people a day, that's easy to measure. And so that's really good to have those types of measurable goals that can keep you accountable. Because I think that's the biggest challenge with goals, is that we're not held accountable for them. Um, because they are, a lot of times they are super vague, like 600 units. I want to buy 600 units. Well, what's that mean? What if I don't do it? Well, do I chalk that up as I tried hard, but the market didn't cooperate? Or do I say, well, I really didn't do a very good job at, putting myself out there and making sure brokers know and making sure I'm on contact with them. And I didn't make, 10 phone calls a week, and I didn't write 5 offers a week, and all that kind of stuff. So having very detailed measurable goals, I think, is a lot better than a vague goal of 600 units.
Yeah. Well, and that's kind of what I was getting at too. I mean, so I'll just tell you. So I want to make 100 new contacts per week, and a lot of those are phone calls, but some of those might be Facebook direct messages or LinkedIn, or some of those are emails. That's kind of my last resort. But if that's what I've got, I've got an email.
Yeah.
Um, and I've let a couple people know this. So I've got an accountability partner on that. I've got somebody else who's in the office, and on a daily basis, he's like, all right, you get your calls in. So yeah, it's really helpful to not only set those measurable things, but then let other people know, and that can check in on you and see what you're doing. So
Yeah, that's great. Also, obviously, if you can have accountability partner, like you said, maybe somebody who's even doing the same goal with you, can be really helpful
mhm.
for
Yep.
sure. Cool.
Anyways, that's not exactly what we're going to talk about here today, right? Um,
I don't think so.
but anyways, okay. So today we wanted to talk about apartment income and expenses, and so a couple of different detailed aspects of that. So
Yeah, exciting topic, right? But it's a really important topic, and I actually enjoy it. But it's a really important topic for people to understand. I think a lot of, and we last week we talked about vetting sponsors, and this is a really good way to vet your sponsors too. Is if they don't have these details in that we're going to talk about today, you can kind of tell that they don't know what they're talking about when you see a sponsor that their details are, their income, and then maybe they have a 5% vacancy loss, and that's it. They don't detail, they don't break it down more than that. They don't have maybe any other income, anything like that, and maybe their expenses are kind of vague as well. We know that maybe they didn't put the thought into it they should have. Maybe followed a broker's offering memorandum. Maybe they took it from some guy that's selling a spreadsheet online type of thing. Who knows what? But that's important to understand. Do they really understand the apartments and all the moving parts to them? So what we're going to talk about today should help with those who are looking for passive as well as active investing.
for sure, yep, because there can be a lot more to income than just rental income.
Right.
So let's go through a couple of those examples right now.
Yeah.
So one other one that a lot of buildings have is the laundry income, if it's coin
Mhm.
operated or maybe you swipe a card. Um, but that can be a huge source of revenue right there.
Yeah, laundry income can be a very valuable source. And so having good laundry um, can really help out. Some people like to do laundry in units, which maybe that's not a second source of income. However, it might raise the rents a drastic amount as well. So, that's a kind of a different topic that's value add, but, um, you know, yeah. So let's just stick with, we're doing coin operated. That's another, or swipe card, whatever you want to call it. But that's another income source that a lot of people maybe aren't counting in as a factor.
Yeah. And now on that, what would you say, when does it make sense to transition from a coin operated to a swipe system? And also, like, does it make sense to own the machines or have them outsourced and serviced else, by an outside company?
Yeah, that's a good question. One I don't know that I have the answer to. There's advantages and there's disadvantages, right? So you're going to make less money if a third party is managing your laundry. You do, of course, have the risk of theft because they could falsely report what they're making. But if it's a reputable company, um, you should be okay there. So the nice thing with that is they service their machines. They keep those up. You don't pay for that, and they just collect part of the income. Now, again, you're making less money off of those, um, but out of sight, kind of out of mind type of thing. So yeah, pros and cons about doing both. If you want to maximize your dollar revenue, um, doing it yourself is probably going to save you some money. How much and is it worth the hassle? I'm not quite sure about that. I haven't really done any studies on which way is going to be the best.
Yeah, it probably could depend on if your on-site maintenance person really can handle the appliances aspect of the repairs, because
Yeah.
that can be a whole trade in and of itself. Um, I mean, on the one hand, it can be a very easy thing to fix if you know what you're doing. So if you have that right maintenance person in there, then they can really take care of those machines and keep the maintenance expenses down with that part.
Yeah. Yeah. I think it's easier and maybe more professional to go with like a major provider.
Sure.
So
Yeah. Okay. So laundry is that one big thing, and then of course, parking is another area that you could get income from, whether it's just uncovered or garage parking.
yes, you got garage parking, you've got covered parking, and then you've got just uncovered parking that maybe is closer to the building, maybe the front row, maybe even the front two rows. You can charge a little bit extra for those. Uh, Depending on how your building is set up, maybe each tenant gets one parking spot and they can pay for a second one, or maybe they get two and they can pay for a third one. However it is, you can do that as well. So there's definitely options for parking. Depends on where your property is located. In Minnesota, people will pay for that extra garage stall or some covered parking areas where um, you get a lot of ton of sun and hail, different weather. They'll often want some sort of covered type parking. Um, like I said, Minnesota, people like garage parking. The garages are very valuable because not only can you charge for garage parking, because most people want their car in the garage, but a lot of people will want to store crap in the garage because a lot of people have too much extra stuff. So you can charge for the garage stall and you'll get a good chunk of your tenants that'll want to pay for that as well. So that's a pretty good source of extra income and pretty cheap, especially if you've got extra land, you can potentially even build those garages for a pretty affordable price, or some covered parking spots for extra price, and it's not going to cost you all that much to get the extra income for that. It's important to check with the area. What's the area getting? Are we able to get $50 a month? Are we able to get $100 a month? Are we able to get $20 a month? There's a big difference between a lot of different markets. Some markets it just doesn't make sense to do it. It might make sense in an A class property, maybe doesn't make sense in a C class property.
Yep. And I guess, how would you decide if you're going to include those things in the rent as just an amenity that's included versus buying or paying for it separately?
Well, a couple things. One is what's your competition doing? we always want to look at what our competition is doing. If our competition doesn't have that to offer at all, it might be hard to charge tenants for it, or maybe it would be even easier to charge tenants for it. It really depends on the demand there. Some of it you're going to have to play around with. If the competition really doesn't have what you're offering, you might have to play around with, does it even make sense to do? Maybe if you're building garages, you don't build a ton of garages. You only build a few garages to start out with and see the demand there. You got to look at your return on investment. You've got to look at your vacancy factor. Is it going to dissuade tenants from, renting your place if you're charging nickel and diming them? What I think, and this is maybe more of a theory than a fact. What I think is a lot of tenants, when they look at the expense of their living, so their apartment, what they're looking at is what the rent is. So maybe the rent is $1,000 a month. Well, maybe you can charge them RUBS, which we'll talk about in a little bit. And that ends up being $75 a month. And maybe you can charge them on a garage stall, which is $50 a month. And maybe you can charge them on your laundry and you end up getting another, a couple bucks a month from that. And maybe you can even charge them some other small fees, maybe some other, storage fees or something like that. What my theory is that most tenants will look at the rent as their expense. They won't look at all these other things as kind of part of the rent expense. It's just other expenses, but they don't count that into their rent budget. So if your rent is $1,000 a month and then you add on all these other things, and these are extras that they pay for, they'll think they're paying $1,000 a month for rent. Where if you charge them $1,200 a month for rent, they'll think their rent is $1,200 a month, whether those amenities are in there or not. So they'll actually go, I'd rather save the money and pay the $1,000 a month in rent than this $1,200 a month in rent. Even though at the other place, they're probably paying $1,300 in all when it's all said and done. So I think there's that kind of mind gap there where most people don't associate the full expenses. Again, that's a theory. It's kind of a theory tested by my own apartments, but I guess it's not extensive research.
Sure. Well, that makes sense. Everybody's going to have a different outlook, but it makes sense where if you can get the basic rent down further by or separating out the different amenities, then they can have a positive outlook on that.
Yeah, they look at their rent and go, "Oh, I'm paying $1,000. Wow, you're paying $1,200 a month. I'm only paying $1,000. I got all this other cool stuff too." Well, when they add it all together, it ends up being more. It's just like the perception when somebody buys a house and they go, well, "My mortgage is only $900 a month or $1,000 a month, and I was paying $1,200 for rent." Well, now you're forgetting that you have to pay property taxes and insurance and utility bills, and you have to do repairs, and the roof needs to be replaced in 5 years, all that kind of stuff. So we forget that. Instead of paying $1,000 for our mortgage and that's our living expense, we're really paying $1,800 versus $1,200 or whatever that ends up being. So a lot of people don't consider all these expenses. They go, well, it's just as cheaper for me to buy than to rent.
Yep. Well, I guess the other thing to consider with offering these amenities separately is just some tenants might not need or want them, and then other tenants might want more of them.
Right. So more of the a la carte.
Right. And you have the option of spreading it around. And for example, parking spaces, so you got 100 units, but you have 150 parking spaces. So some people will have 2 cars and some people will have 1 car. So
Yep. Hey, I want to interrupt this episode real quick to talk to you about Nate Armstrong, our sponsor, Nate Armstrong. He's with homeinvest.com, and you want to get to know Nate. So go to homeinvest.com and just connect with Nate, talk to him, learn about his operation, what he's got going on. He's a turnkey provider, and it may not be right for you, but it could be the perfect fit. So it doesn't hurt. It's a free call, consultation just to figure out, what they do, what they have to offer. And worst case is you're going to meet a great person who's really well educated in real estate. He's done a ton of different real estate strategies, and probably is going to teach you a little bit, even on a short conversation with him. So go to homeinvest.com and connect with Nate's company. You're definitely not going to be disappointed. It's worth it. So thanks, and we'll get back to our show. Let's talk about some of the other fees that we can charge tenants. We've talked about laundry. We talked about parking. Some of the other things I'll mention, and then you could maybe ramble off a couple too. We can charge for some of the extras, like maybe we have a room that they can rent. Maybe they can rent the pool for a few hours, especially if it's during like non-busy times. We can rent the pool. Maybe they can, maybe there's secured lockers or storage that they can rent, even if it's on a 1-day basis, like they're getting some Christmas packages. We just went through Christmas. Maybe they got some Christmas packages they're worried about getting stolen. So they want to rent this secured storage area for $50 a day or something like that. There's also RUBS, which I've mentioned. So it's utility billing, basically ratio utility billing. And so we bill them back based on the amount of utilities we think they consume, and that's based on a formula. It's not just like we think they consume $100 a month, so we're just going to charge them that. You have to charge them fairly, of course. There's ratios for that. Every municipality is different, so you got to check with that and make sure you're doing it right. But so we can charge them some utility charges back. What else, John?
Yeah, you can put in other services or vending machines, either machines that you own or maybe you rent to a vending machine company so they can place their machine there. Or if you just have other services, depending on the class of the property, maybe you have a dog walking service, or maybe you have cleaning service. I don't know, just different services you can provide that are an amenity to the tenants there.
Yeah, in cable too, cable and internet. You can have packaged cable and internet, and a lot of service providers will actually give you a portion of their income if the tenants sign up on that. So, tenants paying $100 a month for their cable, internet package, and you get 10 or 15% of that, or whatever it works out to be. So a small percentage of it. So there's that too, that you can get. You could potentially get fees for a massage therapist coming in, or a hairdresser, or all kinds of stuff that you could do, like you said, depending on the class of the property and the types of amenities that you have. So, well, cool. So that's extra income. The next thing I want to cover, and this is more what we need to make sure we're thinking about as we're analyzing these properties, is we've got vacancy loss, right? So we've got loss of people that aren't living in an apartment. And I don't care who you are, you're going to have some sort of vacancy. If you got a 100-unit building, you're likely going to have vacancy. And if you don't have vacancy, that means you're not charging enough for rent. You should have close to market vacancy. So if market vacancy is 5%, you should have somewhere between, I'd say at the very, very best, 3%. So be somewhere between like 3 and 7% if your market's at 5. That tells you that you're charging, enough in rent. But we also have what's called economic vacancy. And economic vacancy is something that we need to be very aware of because it's very real. So in economic vacancy, we have a couple different types. First of all, we have bad debt. And by bad debt, that means I've got a tenant who didn't pay that month. Or maybe they paid part, but not all. So we've got bad debt, and that happens. It's guaranteed it's going to happen. You've got maybe a skip, or maybe whatever it is, but you've got a tenant who didn't pay, who's living at the apartment. You're likely going to have to evict them. So that's bad debt. You also have concessions. right? So not always, but in markets that are really good like this, we have less concessions, but we do have concessions. For instance, right now it's winter. We're doing renovations on some of our properties, and it's hard to get tenants in the winter. So we're offering concessions. We're offering them a gift essentially to come in and move in. We're not lowering our rents because we want to keep our rents at market rate, but we are giving them a half a month free if they move in this month. So you can do stuff like that. So typically you're going to have some sort of concession built in. Most of the properties that I underwrite, it's 1% to 2%. Same thing with bad debt. It's usually 1% to 2%. Depends on the class of the property and all that kind of stuff. The last thing you have is loss to lease. And what loss to lease means is what's my market rent? So maybe my market rent is $1,000 a month. Well, maybe I've got out of 100 tenants or 100 units, I've got 25% of them are paying on average of $60 under market. So I got a loss to lease of that, $60 per unit for 25 units. And that's important to know as well.
Yeah, that's important. I was asking about this before the call. Just the importance of knowing that, I think, is just so you can be understanding what the potential of your property is. What's written in the lease is what's written. You can't change that until the lease expires, and that's what's the scheduled rent. But it's important to know what the potential rent is, and that's where that loss to lease factor comes in.
Yeah, absolutely. It's important to know all of these factors to know where your performance is. So we want to know what the actual vacancy is, because if we're trending at 92% occupied, but the market's at 95.3% occupancy, we know we're doing something wrong. Maybe we need to step up our marketing and advertising. Maybe we need to do some tenant retention programs. We need to change some things. Maybe our leasing staff is just not doing their job. Whatever it is, we need to change some things. Same thing with bad debt, with concessions, with loss to lease. If we're way above what the neighboring properties are at, we need to make some changes to try to get that to be in a better spot. So it's important to know all those terms. It's important to understand that they actually do happen too. I think a lot of people just go, "Oh, I'm going to have." I hear market vacancy is at 95%. I should be able to keep my property about 95%. Maybe I'm going to be conservative and do it at 96. Well, are you considering all the other things that do take place in that property?
Yep. And knowing and understanding these numbers for your property really helps you treat it like a business. Like you said, once you have the knowledge of those actual statistics, you can take action on them. Whereas if you're not tracking them, you don't know what they are, then you're not sure what you can or should be doing to improve your property.
Yep. So let's move over to the expense side, and some of the biggest expenses that I see maybe mishandled in underwriting. One of the biggest ones I see, I think, mishandled are the taxes, the property taxes. And the reason being is because the property owner maybe bought the property for $7 million, and I'm going to be buying it for $10 million. I'm basing oftentimes, and the brokers typically are basing it on the $7 million. So when you look at their pro forma, taxes are, $70,000 a year. And you write that in your underwriting, $70,000, property taxes, boom, it's going to go up 2% every year. Great. What you missed is that you're paying $10 million for the property. So now instead of $70,000, your property taxes are going to be $100,000. Now that's a big difference. So I see that a lot of times people miss that. They look and see what the broker says. Maybe the broker's even looking at it and saying it's going to go up. But are they showing that it's going to go up to the right amount? You should be able to figure that out fairly easy by going onto the county website and figuring out what the taxes are. You might have to also go onto the city website if there's extra city taxes. You could also look at what the assessed value is versus what the property taxes are and figure out the percentage, right? So maybe it's taxed at, 1.2%. And then you could take your new value, the 10 million, and multiply it by 1.2%, and you'll get where your taxes are. But typically by calling the county or going onto the county website, you can get what the property taxes will be. And then if you're in a big municipality, you might have to also do the same thing with a municipality and find out what their taxes are too. So you can add those two together. Maybe the county's at 0.7%, maybe the city's at 0.3%. And so altogether you're paying 1%.
Yeah, I'm sure that's overlooked a lot just because we just assume it's going to be what it has been. But once you purchase it at the higher price, suddenly the county assessor has a lot of evidence that it's worth more.
Yep. And they are going to raise it. So beware, they are going to raise it. The other thing, I think, insurance is fairly easy to figure out. Usually what the previous, owner is paying is going to be fairly close. You're about that 250 to 275 a unit, depending on where you're located, of course. Make sure that there's no, you're not in a flood zone. If you're in a flood zone, of course, your tax or your insurance is going to go way up. But that's a really easy thing to do, is just get a quote by an insurance provider, especially before the end of your due diligence period. But if you ask your insurance provider, hey, I'm buying a property in Minneapolis, Minnesota, what about am I paying for insurance on a per unit basis? They should be able to give you that fairly quickly, or on a price basis, per pound basis. So that should be fairly easy to get. The next thing I would say, probably the next biggest, or the couple biggest mistakes I see made are on-site management or management overall, right? So if you're buying a value add property, oftentimes that property is maybe slightly distressed or hasn't been run the best. Well, if it hasn't been run the best, what do you think the problem is? Typically, it's the people, right? And so if you're going to fix the people, but you're going to pay the new people the exact same amount as the old people got paid, why are you going to expect different results? So if you're going to be adding value to this property by fixing how it was managed, expect to pay more for management. Expect to pay more for on-site staff is probably the biggest thing. The third-party property management company, usually those are pretty standard. You're going to pay 4 to 5% or 3 to 5%. But the on-site is where you might have a big difference. Maybe they skimped out and they had, the inexperienced on-site maintenance person, the inexperienced leasing agents, just inexperienced people, and they're paying them, $15 an hour, where they should have really been paying some more experienced people and been paying them $22 an hour. So that's a big mistake I see people make, because they go, oh, the last guy paid nine grand a month on-site staff. I'm going to put that on there too, as $9,000 because they did it. I can do it. Instead, you should be putting 12 grand or something like that. So just pay attention to that. Why is the property not performing the way it should be, and what really should you be paying for that?
Yeah, and this probably touches back on, having good team members on the ground in that market, so you can talk to and learn what are the going rates for on-site management from these different companies and what to expect with that.
Your third-party management company should be able to give you an answer, especially if you say, look, I want to run this asset high quality. I want to make sure we're performing top notch. What's it going to cost to run this property? And I would always quote on their high end. If they say, well, we're going to pay on site anywhere between, $11 and $13,000 a month, I would put it in my underwriting the $13,000 a month. Trying to think if there's any other expenses that a lot of people miss. Just make sure your contract expenses are right. You're paying for your exterminators and your lawn care and all that kind of stuff, your snow removal, all that. Make sure that's in your underwriting. The other thing is make sure your maintenance expenses are actually going to be accurate. A lot of sellers like to, especially right before, they like to put a lot of their maintenance expenses into the CapEx budget. Those are fairly interchangeable. So a lot of sellers are savvy enough, or maybe slimy enough, whatever you want to call it. But they're going to say, my maintenance was only $100,000 this year, when in reality it was $175,000. They just took $75,000 and they put it in their CapEx budget. So we want to make sure we're really thinking about the maintenance and what reality is. Most third-party property managers will have a pretty good idea of what other properties in the area are running as far as maintenance that are that vintage and in that class of property. So they're going to be really good resources to help you figure out on a per door basis what you should be running at.
Yeah. And if they actually did spend $75,000 on capital improvement, you should be able to see that item improved and be able to plan that it doesn't need to be addressed again for 10 years or whatever, depending on what item was improved.
If they broke it down properly. Yeah. Which, I should say oftentimes, sometimes it doesn't happen. Sometimes it gets lumped into other areas. And so, it's, you just wouldn't know.
Mm-hmm.
So just be careful with that and understand that every seller doesn't tell the 100% truth, and that you need to do your own research yourself and make sure you check with your managers and all that kind of stuff. Your team, like you said earlier, your team's really important to your success. The last thing I would say is the reserve budget. A lot of people, I think, under budget. I hear all kinds of different numbers. I like to use $300 a month per unit. Sorry, $300 per unit per year for my reserve account. That's going to get me covered under, really any loan type, Fannie, Freddie loan, insurance, any kind of agency, any kind of HUD, all that kind of stuff. So
there you go. And probably another one to just be clear on is utilities.
Yeah.
And to understand how they're set up, who pays what, and how old your furnace or boiler is, how efficient are those things. So
yeah, those are good. And that's true, John. I mean, your insurance is easy, or sorry, your utilities are easy to verify, right? Because you can get those reports from the utility companies. But it's also important to understand, are you paying way too much? And I think that's the biggest thing, is oftentimes we're paying way too much, especially in water. It seems like there's a lot of water leaks that happen and we maybe just don't catch them. So what can we do to recover some of those expenses, or maybe the kind of that low hanging fruit that a lot of people don't actually catch, and that you might be able to catch in your underwriting, saying, wow, they're paying, a 25% more than the market in utility billing. What can we do to change that? So it is important to know you'll be able to get the exact expense, but then we can from there dissect, and is there something we can do? Is there maybe some opportunity here?
Yep, for sure.
Cool. That's all I want to cover today, unless you got anything else.
I guess one other thought that comes to mind, just with different programs that are in place, like putting in solar and how you can maybe recoup some expenses that way. Have you had any experience or knowledge in in that area?
And not really, no. I've talked to some people on it. There's some government programs. Every area is different. Every state's different. Every utility company is different. So you need to check with that utility company. You need to check with an expert in the area that knows. I would work with a professional that knows all the nuances of the government programs, because you're dealing with government. There's good incentives for that in certain areas, and there's other areas it just doesn't make any sense.
Yep. So just something to look into.
Yep.
Very good. Well, if that's all we have, then to our listeners and viewers, we appreciate you joining us today. And if you got any input on this topic, different income and expense items to consider with your apartments, go ahead and comment on the episode, or you can go to our Facebook page, Pillars of Wealth Creation, and we can start a conversation there as well.
Awesome. Well, John, I appreciate the time, and hey, make every day a Saturday. Are you ready to start investing in real estate today but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with homeinvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer a property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars to claim your free course today.